So, hello guys, how's it going? Hope everybody's having a great day wherever you are, whatever you may be doing. 50 pips, rocking and rolling here. No trade calls, no recommendations. Everybody's responsible for their own stuff. We're here for educational purpose only. So, what's happening? Let's see if anybody's around. I know it's a little bit of a strange time, but again, try and do these once a month whenever I have some free time. If anybody has the time to pop in live and ask questions, more than happy. If not, I'll do a little bit of a review, talk some charts, and then just post it on the blog. It'll be on YouTube, and hopefully it will be useful for somebody. So again, if you have any comments, any questions, anything you want me to discuss, feel free to pop it into the chat. I don't have any specific place to go, so I can keep on going as long as people are asking. If not, I'll just do a little bit of an overview of what I think is interesting, and then we'll take it from there. So here, Cable, please. Hey man, how's it going? Here, well, I mean, this is in the context of, let's start with a little bit of a review. I'll hit Cable for you. Remind me if I forget, but I'll hit Cable for you. So basically here we're at an extremely key juncture, right? What we've been discussing with subscribers is that it's extremely, once we had that sell-off into 5th of August, which was fairly technical, right? The acceleration came a little bit out of the blue, but the move was very technical. Our base case assumption is that, the vast majority of the time, these lows will get tested again, right? Now, it doesn't mean they have to break, doesn't mean they have to let go straight away, but they'll get tested in a decent manner, right? Right here, what we're having is we've got a continued situation where, we're still getting rotation out of tech and into value. And you can see that fairly clearly on the charts by the weight that we've seen in NASDAQ and how, YM and to a certain extent Russell have been bid. But right here, what we had coupled in the back end of last week is a little bit of a old-fashioned deleveraging, de-risking across the board where everything got sold, even crude, gold, et cetera, et cetera. So right now we're at a key juncture on the weeklies because you can see without looking at any moving averages or anything, we've got these key breakout zones, right? And this is what we've been using on a higher time frame on a weekly as a big bull bear line, right? And that was basically that breakout we got in March. Now, if the market can't hold above that, that becomes fairly, switches the tone to very heavy, not only for a retest of those August 5th lows, but in general, it paints a very, very heavy picture, which potentially calls for much bigger corrections, right? We can look at that on the daily. So again, if you want a reference point on the weekly, these are the key levels I would have on the futures. So, ES, NASDAQ, YM, and Russell. Also, in terms of the calendar, what's very interesting here is that, again, we've got the situation where the market is still holding bid. And, we've been getting some tape bombs here and there, but, usually the way this should play out or the way you would expect this to play out is for the market to want to be long, for the market to want to be bid, and for the market to not even remotely think about going neutral or underweight until we get into that first rate cut, right? Begging for that rate cut. Of course, it's a very different scenario if we're getting into a situation where the Fed assumes that they've done what they need to do and then they start to normalize rates by cutting, 25, 25, 25, 25 or whatever, right? Or in a normal cutting cycle. Or if we get to a situation where all of a sudden, the Fed has to start cutting 50, multiple 50s because there's an issue, right? Because the economy is slowing, because the job market is slowing, yada, yada, yada. So that's something which you have to be a little bit careful. Not all rate cuts are created equal, but also be careful what you wish for, right? Also, here we're in a situation where even though, keep in mind, historically, the market tends to rally into the first cut. And then it's not like the cut happens and it sells off hard. It tends to rally into the first cut. Then you get an additional, rip, which could be, a couple of days, a couple of weeks. I think the average is something like 5 to 7% higher. And then that's where the offloading starts, that's where the selling usually starts. Now here things are complicated a little bit because we've had, the BOJ, and this is something we've been talking about not only with subscribers but a lot on YouTube too, right? You have to keep an eye on USD JPY, right? And as long as that USD JPY is in unwind mode, it's going to be very hard for equities to really rally because, a lot of those buys on the equities or a lot of the buys on all assets are being funded with a carry trade, right? So also the other thing that a lot of people aren't paying attention to is they got excited after the August 5th where the BOJ said, well, if the market isn't functioning orderly, we're not going to hike anymore, right? But right after, they've said, as long as the market is orderly, we're going to hike. Karuta, Wada, they've all talked about that they need to get back towards 2%, and that if the market is orderly, and they're going to continue to hike. Now, think about it this way also, next week we're going into the FOMC, and the market is going to probably, unless something horrific happens here, is going to probably start to try and rally hard into with that FOMC drift into that hopium. But what happens if then 2 days after, right, on the Friday, you got the BOJ, and the BOJ gets their meeting, and you've got equities that are rallying, staying bid all time. But what are they going to do? Well, of course, they're going to hike again, right? And probably more than people expect. And that's, that vicious circle, that's going to mean you're likely going to get a risk unwind. So it's a fairly, I would say, dangerous situation here for the bulls in this window. Also because historically, right, not only is September the weakest month of the year, but also if you look at it, the weakness in September is stacked up towards the back end of the month. A lot of people talk about the last 2 weeks of the month, but if you look at it, it's really that week after September OPEX, triple witching, quadruple witching, whatever you want to call it, is fairly heavy. And another thing, case in point, what's happening next week is you've got on the 18th, you've got the FOMC. On the 20th, you've got the BOJ, and the 20th is also OPEX, right? So I would say, again, especially if you get some kind of a rally attempt, a kind of FOMC drift into next week, into the 18th through 18th, 19th, I would be very careful being aggressively long risk into that Friday, that weekend, and the post OPEX week. Okay, so that's something which I think is really important and something that you should have in the back of your mind. Again, it doesn't mean it has to play out like that, but it's very important to have some kind of an educated guess or of how things could play out, or think always, whether you're coming in on an intraday basis, intra-week, intra-month, is what is the most likely outcome? What is the most realistic expectation? Okay, so that's where we are globally. Now, here, looking at some of the charts a little bit more in more detail. Again, as I said, I think those are the big bull bear lines on equities, and they're extremely important because if we fail these breakouts, then that is a double failed break with lower highs, and it starts to look very, very heavy. So, you could argue that we need to go all the way back to the scene of the crime, right? In the midst of this, as everybody was screaming, die, dollar's going to zero, we got these beautiful reversals on the weekly on Euro, Cable, Aussie, not so pure on Kiwi, and not so pure on CAD. And everything here is pointing to, and it makes sense, a little bit of profit taking from the dollar shorts. And as long as these hold, you would expect all these to come back into, more dollar strength, and all these to come back into a little bit of a more neutral stance into the FOMC, into the BOJ, into next week. Now, what is an easy way or a quick way to look at what you would call a little bit of a neutral stance? If you go back on the dailies, well, basically that means Euro back into this breakout zone and this cluster of moving averages, right? Hold on, this is not on the daily. Cable back into that initial breakout zone and the cluster of moving averages. Aussie's already there. Kiwi's almost there. CAD's almost there. Okay, that's what I would be. I would be looking at. And again, there are a lot of interesting things to keep in mind, but especially, the heaviness in tech is real. And as I've been discussing on Twitter also, as I said, I'd be a lot more focused almost on what is happening on SMCI than what is happening on NVIDIA. And you see no bid in sight, and NVIDIA no bid in sight. I also posted this on Twitter. You have to pay attention. You see all those market on open orders coming in, and in the morning they start to rally, and then you get towards the 11 a.m., 12 a.m. term. They've been smashing this down. So these are looking very, very heavy, and you can look at these also on last week's close. These are some ugly patterns on the weekly, on a lot of those tech names, not only SMCI, which, no way I'd even think about remotely possibly trying to fade this unless we're back into, the 200 or that 300. But, you can look at stuff like Google, very, very ugly on the weekly. We highlighted how these were trading heavy, but you can see here through the 200 DMA right into the 50 DMA. This is a huge, huge, huge level for Google, right? Because we had, remember, this break from September, October, November, towards this resistance from the back end of 2021, which we ramped all the way through, and now we're, not looking pretty. What happens with these kind of patterns? If shit hits the fan, if you've got a lot more delevering, if you've got, that yen starts to puke, there's no reason why this can't unwind and you can't see Google all the way back into the 100. And you've got a lot of these patterns across the board on a lot of these tech names that look very heavy. If you look at the Fangman chart, also on the daily, it's a similar thing, right? You had this breakout from the beginning of the year, fail, caught at the 200 DMA, lower high, and failing again. So, here you have to keep in mind that the buy on the first test of the 200 after it hasn't been tested for a long time is much, much stronger on this first test than if it gets tested again a second time with this kind of pattern, right? And again, we're posting some of these charts on Twitter. This was the one we had on NASDAQ with the pivotal level for the move back into the 200. So again, this week is fairly easy, right? Any hold of the 200, you've got that potential FOMC drift, a little bit of a rally to clear out late shorts, and that could come all the way back into this whole 10-day moving average and this breakout zone, and below this just opens much bigger unwind and much bigger panic. ES holding here 100 DMA to the upside. You've got this cluster of the 10-day and the 50, which is going to be a key short-term level to the upside, and to the downside it's the 200 DMA. Now, of course, you have to see if we flush back towards the 200 DMA, you have to get a feel for how it's happening and what it's happening based on what the other charts are doing, also what yen is doing, because there could be a case to be made to look for a buy or for a completely stand out of the way. I think here today, this morning, this is a little bit of a gap up open, which it looks like we're trying to get, is far better open for the bears than for the bulls, really. The last thing you really wanted if you're a bear is to see like a little bit of a shy gap down open, because that's very buyable. You'll get a lot of buyers trying for that. Here, a little bit of a gap up open, it's a little bit better for the bears if they want to lean into it. Again, we still have data points this week. There's a lot of wheeling and dealing. Most likely next week and the week following that, but especially I would say the next week, Wednesday, Thursday, Friday, and the following Monday is a far more interesting stretch in terms of also to add weight to whatever analysis you're going to do of the price action, than what's going to happen this week. Gold, we're hovering here. There's really, you may see a little bit of a panic unwind in gold, but you would be surprised to see super aggressive sustained selling here. So here, what you want to watch essentially remains that 2,500 bull bear line, right? As long as we hold above there, then there's very little reason for a broader pullback, but all pullbacks are probably going to get bought here. I don't think this is particularly interesting here because it's not cheap enough to buy. It's not expensive enough to sell, really. So it's sidelined. You're probably going to get a lot of short-term traders chopped up here. It doesn't make, it's just not that interesting. Crude, this is a very very tricky one, because the problem is the chart looks like doo-doo, and it really looks like it wants to flush these lower levels. But the problem is you still have a lot of geopolitical risk. So even though, even the headline flow may be bearish, you could always get a little bit of a geopolitical headline that messes up your short. So it's a really hard one to short or to get long here. I think the only thing you have to keep in mind is that, essentially, around the 70 mark, I think most people or most producers are still okay. If it starts to trade much lower, then some people are going to panic. But, keep in mind, look at this level. You can go back on your chart years, and this is a huge, important bull bear line around the 65 inside this level. So really, as far as I'm concerned, inside the 70 and the 60 is really kind of like a chop zone where you'd want to just kind of trade this range. But I don't think it's time to be necessarily aggressive trying to sell this or buy this. I think on a close below 60, this gets very ugly, and on a close back above 70s, then you could see a little bit of a pop back into the 80. But again, this is also one which I'm not too interested to trade right here, especially when you've got so many opportunities on equities which have been extremely technical, and finally, past 2 weeks have also been very interesting and very tradable on FX. So the last thing I want to do is try to get in trouble trading crude here. The dollar, we're still stuck. It's a huge level. You can go back in time, and this is that 100, not only a psychological level, but it's just a big level. This is that high from 2014, and then once we broke up, then we came right back into it. And here, we've pretty much spent best part of the last 2 years with dollar bulls screaming dollars going back to 120, and dollar bears saying dollars going to 80 and it's worth absolutely nothing. And what the market has done is a good job at catching everybody off guard and staying in this broader zone. Now, our base case assumption remains that unless we start to see the Fed moving, right? The Fed moving and moving in a clear manner, it makes a lot more sense for price to stay stuck inside this range with 106 top end, 103 mid, and 1 bottom end of the range. But again, if we see more decisive and sustained moves communicated both from the BOJ, but especially with the FOMC starting to lay out a proper path, then there could be a reason for this to break out of the range. But unless we see something concrete, it's likely that we continue to trade inside this range, and we'd be sellers of 106 and buyers of 100s, and then close outside will likely get follow through. These ranges that have held for so long, these key levels, they usually get follow through. But it's very important not to get aggressively long just ahead of the brick wall, or aggressively short just ahead of a brick wall. You have to understand the importance of that range. Now, USD JPY, no big change for us here. Again, full disclosure, short this since that break at 160, added back on this move back into the 50 DMA, and still short, still looking for a move back in the 130s, ideally in the 120s. Don't think this is going to change. Again, I'm not going to go through the whole discussion we've had with subscribers. It's a little bit long, but basically still looking for this to unwind lower. I think here, if you're looking at big levels, you're looking at 152 to the upside, and you're looking at 130, the 200 DMA, and this is a kind of a big potential air pocket where you could see big multi 100 pip moves either side, very quick for apparently no reason or just on a headline. So you have to be careful trading inside this zone, especially if you're holding overnight, whether overnight or over the weekend risk. Euro, no change. It's just like that dollar flip around. Unless something substantial happens, and we've been discussing this, sellers at 112 and buyers at 105. And you can see this also if you go back on the daily, how pure this was. We came right back into the 112, daily reversals at the 112 back, so again, to stay in range, we need to have something concrete for this to break outside of the range. Cable, we posted this actually on the on Twitter, I think on the 1 hour trigger, right? When it was back at the top end of this range and it was stalling. And here, it's just a little bit of a correction in range, and this could easily continue higher, but come all the way back through the 129. Now, if you think about the situation in the UK, you could argue that's really not what you would expect. But right here, without having a bias, the market has triggered shorts, and all these shorts and this second negative reversal, and as long as it's holding below the 10-day points to a move back towards the 129, and then we'll have to see some kind of resolution, right? Aussie a little bit less interesting because it's already made its way back into this neutralish zone, so not that interesting here. Aussie pretty much back into that neutralish zone, not really that interesting. CAD, this is a really hard one to trade, but this is a huge chop zone here. This breakout zone with the 200 DMA to the upside as resistance and this low. So I think here the risk is on a break above, this could really overshoot, or break below, this could really, you got big levels both to the upside and the downside. But here it's very choppy. All things being equal with, all the data out of Canada, the wheeling and dealing on the commodity side, the wheeling and dealing with crude and Middle East. This is probably my least favorite currency pair to trade here or to be involved in. Again, bonds extremely interesting. I'm going to use TLT just to make it a little bit easier and not have to go through all the futures. But essentially, similar to that dollar, right? What we discussed is unless we get something clear, we'd expect it to be stuck inside a range, and the range we're looking at TLT is basically these 99.50s and 85 to the downside. And you can see here, it tried the breakout, but again, it's stalled once again, right? Reversal here, clip new stops, and just couldn't get traction. Now pre-market below, this is a big level from December 23. So again, look at it as a range until it's not a range. What does that mean? If you start getting, especially weekly closes or Momo closes on volume, daily positive closes with volume above this range, then the risk is that, again, we're accelerating back into the 108s. But as long as we're stuck here, the risk is that we're still going to be in this choppy zone until we really decide, or the Fed really tells us what's going to happen. Keep in mind that the market is still, since December last year, begging for cuts, pricing in a gazillion more cuts than what is realistic, and keeps on getting caught off guard, right? So until we have a clearer picture, chances are a lot of people are still going to be slapped around here, and it's messy. Even though it is, as you would expect, trying to move higher, but these things don't happen in a straight line, and we need a catalyst. And the same discussion as we had on the dollar. It's exactly the same thing here on TLT, right? Gone through most of these. I don't know if there's anything else we missed. DAX got clobbered last week. Not looking too pretty here. No surprise. Euro stocks looking very heavy here, trading below the 50. Any sale here that can't break this whole series of lower highs is still ugly, and you'd expect, again, that low to get retested. We'll have to see how that happens. Nikkei, again, all over the place, crazy moves, but still heavy. You would expect this to trade broadly in line with USD JPY, so go back to the discussion we had there. Again, I don't know. I think I covered pretty much everything. I don't know if anybody has any comments, any questions. Everybody's very shy. Nobody's asking questions. So that's pretty much it on my side, unless somebody has a question or anybody has a chart they want to have reviewed. Again, nothing off the table. I don't mind. You can ask anything you want, whether it's trading-wise, trading psychology, position size, whatever. I don't. USD CHF. So I suppose USD CHF. Hey, how's it going, man? Long time no see. So here, are you looking at anything specific here? I mean, let's just do, so if you're looking at it on a monthly, right? Here it's really at a key zone. You see how you've got this low from 2015 one of those massacre lows from 2015, and it looks like that's being defended, right? Probably psychological level. And funnily enough, if you remember back, that candle was extremely important. And look what's happened. Essentially, that range has been holding, right, since 2015. So this is an extremely important zone, but I would say it's the same discussion we have. You don't want to get long in front of a brick wall, and you don't want to get short ahead of a brick wall. You prefer for it to break, and then you step on it, even if it means losing a specific portion of the move. Does that make sense? So it's important to understand the concept of it's in range until it's still in the range, right? Now, of course, the extremes or any support or resistance line, the more it gets tested, the weaker it will become. But just because it's getting weaker doesn't mean it has to break, right? Or doesn't have to break within the parameters of your trade, right? So here, this is an interesting zone. And what I would say, I don't trade this, but in general, whether you're looking at this chart or another chart, this is a useful thing to think about. These areas are, in brackets, super interesting, right? Why? Because these are areas where you truly have asymmetry, right? Both for scalps, both for swings. So what does that mean? That means, if all of a sudden you get a kind of break and fail to close below or positive closes, trying to get long here for a move back, let me do it in red, with a stop below whatever low sets up, for a move back to the middle of the range or the opposite side of the range, still in the context of a range trade, offers lovely risk reward, right? Equally, if this breaks down and closes outside, getting short with a stop above, say, today's high, whether you're getting short for a little bit of follow through in a trend, right? Or you're getting short for an absolute puke back into these lows, the asymmetry, right? This is always your risk, and these are your rewards on the trade, right? So this is a very interesting location if you find this kind of location on any chart, right? So here, especially on the bigger picture, you want to see what happens. So it's almost like you have to have this low, you have to have that line on your chart, right? Yeah, it's almost like here, if you're trading this actively, especially from a swing, if you don't have the monthly extremes, right, from that January 15 as the high and the low on your chart, you're kind of not doing it right. Again, if we're going back on the weekly, could it be forming some kind of a inverse head and shoulders, some kind of a bottom? Sure, but it's a range trade. Do you see what I mean? So here, as long as we're holding this level, it's tactical longs or swing lows, and the moment we're breaking it is tactical shorts or swing shorts. And keep in mind, those tactical longs could only be longs for then a continuation lower, but the level is beautiful because of the symmetry it affords. Does that make sense? Does that answer your question? It's very interesting location. And it's a similar kind of, thanks for asking the question. It always allows us to look at something interesting instead of me just babbling. It's a similar thing on TLT, right? See, this same kind of discussion. You've got these previous highs with this level that's being defended. This is offering you a super interesting zone, right? Scalp shorts or swing shorts, as long as we can't break above, with very tight risk for very nice potential rewards. Break above, scalp longs for just a little bit of a scalp, or for the bigger move with very tight risk. It's a very, very interesting location. You get when you've got these horizontal support or resistances in range or with multiple horizontal, they're far better than, even though in terms of drawing squiggly lines and pretty pictures, the channels look much nicer. You know, you can put all kind, but they're much harder to trade. You know, the moving averages or the channels, usually, especially the channels, any line which is not horizontal is usually much harder to trade. So, you know, it's an interesting chart. Thanks for the question again. Any comments, any questions? Anything anybody wants to look at? Again, don't be shy. I'm more than happy to look at anything. Okay, let's look at, sure. Do you want to look at the futures or the cash? Do you mind? Do you have a preference? I think the futures are a little bit cleaner, if you don't mind, but I'll bring up the future. Okay, let's look at the cash. We'll look at both. But anyway, here, big question on Bitcoin is, you know, is it surprising that we've got buy the rumor, sell the rally on the ETF launches, right? Not really, right? Not really. I think we can all agree that's not crazy. Now, the problem is really with all the, if you think about it, with all the money that's gone into the space and also all the geopolitical risk that's happening, there've been a lot of occasions where you would have expected this to be a flight to safety. Or if you see what I mean, right? You'd want it to be a flight to safety. And the reality is that, as we've seen in the past, and again, not to make a judgment, is just the levered bet on NASDAQ, really, right? On risk in general. And so the question is, does it make sense to trade this actively when you can trade the futures when, you know, VIX is in the 20s and the 30s, whatever, you know, you can trade something that's a little bit less crazy at times? Probably not, in my opinion, but or at what level does it make sense to load up on this again if you're looking for a swing for a long-term hold? Here on the chart, to me, it's just it just looks really bad, right? It looks like really bad. It's hard to trade because of all those wicks, right? So I think here the same thing as you're looking at that, you know, that 5th of August low. That looks like it wants to be retested. Now, is this trying to put in some kind of a base? Yes, but I would suspect that if you see more unwinding of USD JPY in the same way as equities are going to have a hard time holding a bid, I would expect this to have a hard time holding a bid. And I would say that if the August 5th lows clear, then you're looking at sub 40 for buys. Right? And again, you can look at it in a lot of different ways. You could look at some trend lines. You can look at the cluster of moving averages. There's a lot of things that are pointing inside this. You see this 40, 35, 35,000, 40,000 range. That's what I would be looking at. But it's I mean, would I want to short this here into all these wicks? Not with somebody else's money, right? Zero interest to be short this. But equally, do I want to be long here? It's not expensive enough to sell, and it's not cheap enough for me to buy. Also, this continued lower highs and selling is just not pretty. This repeated failure to hold back above the 65. Do you see what I mean? I don't know if you have another view, but it's just not looking too good at a time when it should be looking better, right? At a time when it should be looking better. And even here, you know, when you start to see this kind of action, you know there's stops that need to get flushed below that. So what are the chances that they're not going to try and flush these stops? They're bound to be levered players with a lot of stops here, it's going to be extremely tempting to flush these. Even if you want to buy, just to flush these and buy lower. So I don't know. Does that answer your question? That's the way I would be looking at it. Anything else? Something people like to look at usually is Tesla. Tesla also is just kind of stuck here. I would be surprised if it doesn't, well, not surprised, but I would expect it to try and come back and test this August 5th low. I think these August 5th low are interesting across the board because to a certain extent, when we got this first round of volatility and these flushes off these highs, right, in July, whether you're looking at Tesla or whether you're looking at ES, right, you got a lot of the people who were used to the market only going down got scared to start off with and got flushed, and you got a little bit of downside Momo. Then what happened is the move off the lows on August 5th was so nuts, right? Remember, never forget, guys, we had, you know, the quickest vol smash or the biggest vol smash, the big on nothing really we've ever had in history. So what that did is completely erase any amount of doubt that long only is the way from all the people who'd be blindly buying and just because they're buying a bull market, right? So here I think what's important psychologically with the August 5th low is that whether you're looking at crypto, whether you're looking at tech, whether you're looking at ES, whether you're looking at anything, if we trade below that, you're likely going to awake memories of August 5th, but some people who were ready to be on the sidelines or flip short that didn't because of the miraculous save on August 5th will be far less likely to buy. So think about it. Everybody who bought the dip aggressively here and the people who chased because they didn't want to buy this because this looked ugly, all the people who chased or are still underweight are not going to buy if we flush these lows. All these natural buyers that were here are likely going to be much lower on a retest of those lows. And the big question is also psychologically, if that unwind happens, you know, how does that affect the psyche of the market? Now, again, keep in mind, we're in an election year. So also not only are September seasonals heavy, but also in election years, especially when you've got an election which is very, very divisive, very opposing candidates, a lot of hate on both sides. It is not uncommon for people to want to take some chips off the table ahead of the election because nobody knows what's going to happen. You know, who's going to win? Is the other candidate going to win? Are people going to accept the election results? Are we going to get panicked? So there's also a natural flow of de-risking, de-leveraging that happens into the election. Now, usually that money all comes back right after the election. And then, you know, also that will fuel coming back with when people realize it's not as bad as it is, yada, yada, yada. And also going into year-end markup, Santa rally, yada, yada, yada. So it doesn't mean that we're necessarily setting up for a retest lower and a multi-year bear market. It just means that this is a seasonally weak period. Because of the location of where we are, there could be a flush that catches people off guard and set up a decent long. Now, again, things could happen and set up something like a bear market or multi-year bear market, but that's not where we are now. There's no signs of that. You know, everything, thinking about that, that's all crystal ball stuff. If you're thinking what's the most likely thing here is just to see, be careful in September. There could be some weakness. If there's going to be weakness, this is the best place for it to come, and everything is set up for that to happen. If that happens, because we are going into a tricky election, that weakness could easily continue to be heavy to side in October throughout that November, and then in November we'll see, right? But that's just a way to try and think of a possible framework. Okay. Any comments? Any questions? Okay. I have no idea how long we've been going for. Don't want to make this too long for YouTube, but let's see. Last chance for a question or anything you want me to review, or we'll wrap it up and we'll try and do this again in a month or so. Again, for those who want to join us, we do this pretty much every day in the daily webinars. If not, we'll catch up in about a month time, and as usual, we'll continue to post charts on Twitter. Okay, guys, wishing everybody all the best. Thank you so much for the guys who stopped by. Thank you to the two of you who asked questions. Makes it a little bit more interesting for me too. And catch you guys soon. Thank you so much. All the best. Bye-bye.